for the first week of June, one of the fastest recoveries in history, at least over the last century, this equity market recovery. It's looking more like a check mark on the equity side. We'll talk about GDP a little bit later. But unfortunately, as the equity markets have increased, the corporate profits after tax have collapsed. And that's further analyzed if you look at the 12-month earnings per share consensus going down 20%, while the PE multiples have increased dramatically 18%. I thought it was interesting to see that there really is no causation from a lot of these types of events to the equity markets, more so correlation. As expected, most government bonds in the world now are trading lower than 1%, and that's for the foreseeable future. I thought looking at how trade has been affected as a percentage of GDP, where the trade wars made it fall down, the virus has made it collapse as a percentage. Just an anomaly out in the marketplace. Switzerland is really in a deflationary marketplace, and they've held the euro strengthening against the Swiss Schiffel is an indication of that as well. If you look at the collapse of a lot of the emerging markets from a currency standpoint since March 1st, as a percentage, Rand has collapsed. Brazil, Mexico, Colombia, Russia, all are having problems. Unfortunately, Turkey has continued their foreign currency market problems, as you can see here additionally, where the real basket negative being closer to 20%, Brazil being catastrophic as well, and Mexico. Even though Russia's been having issues, their real effective exchange rate has actually increased. At the time in March, when everybody was having the major shutdowns, a lot of countries, as you can see, basically sold their treasuries to infuse that cash into their direct local economies, even though their foreign currency reserves are mainly U.S. dollar denominated. Fed, generally speaking, has a lot of room for actually using the cash. They haven't really pulled down most of it, as most of these programs haven't even started. I thought this was just fascinating, the global picture of GDP, with Southeast Asia being such a large percentage, with Middle East included in there, and the shrinking percentage of Europe. This is actually a couple years old, and it's gotten a lot worse since then. From a GDP standpoint, we had expected more of a checkmark type recovery, and that looks to be the case, but it's going to be a couple years before we get back to parity. U.S. markets, generally speaking, even though it's super negative on the GDP standpoint, it's really only about a 5-year pullback in real terms, with a recovery that should take a few more years and get back on track. One thing that's really weird is the average cost per square foot has increased and the purchasing demand side has increased, but the real thing is that the supply has collapsed, where just the number of listings out there is just nowhere near where it has been historically. The second largest purchase most people make outside of their home being the auto, expecting a recovery. We can see that also as the number of people are starting to drive again increasing, which is good for the economy as a leading indicator. And then also how gasoline supply is decreasing as a function of that. Crude is typically a laggard when it comes to gasoline supply, so we expect that supply to come down soon. Credit card interest rates, decade highs, not surprising. A lot of unknown risks in the marketplace for both companies and for individuals. Unemployment is weird in the Eurozone, being very, very low, relatively speaking, and not really going much lower. A lot of it has to do with incentive programs, has ticked up a little bit higher in recent weeks. But in the U.S., the percentage of government-related income subsidies has skyrocketed while wages have collapsed. And obviously, unemployment benefits have skyrocketed both on the federal and state level, even though the state has come back significantly. What's disconcerting is the percentage of inactive people has skyrocketed as the seemingly good factors of employed number of people also have reduced while the unemployment rate has gone down. Even worse, seeing a big spike back up in Iran, and obviously the Swedish strategy not being the one to follow, especially if there's another one that is supposed to strike. That being said, a lot of people racing to a vaccine, especially in US, China, Canada, and Russia and UK. A lot of promise. Hopefully something will come through. Unfortunately, in the US market, not too surprising, the containment has slowed down and potentially has reversed, and hopefully we are not going to see that retracement in death rate. I thought this was just a fascinating graphic on businesses by race and the margin related and cash reserves related to those by JP Morgan. This is from that was last year's report. The worst part about all this in the U.S. marketplace is that almost the majority of a single cause or location of deaths being long-term care facilities across the board, very, very, very high. New York, though, being very, very low. Just generally speaking, the older demographics' confidence has increased while the youth have yet to bottom out. And I thought it was just interesting to look at consumer expenditure of people below 65 versus above 65. Nothing really unexpected, but I thought it was an interesting chart. I think the dumbest chart that I've seen this last week is this chart from McKinsey that says that you should probably ignore mathematics and statistics, but you definitely need to learn data science. One being the subset of the other, which is basically, useless chart here. Hope you guys enjoyed.